Hey folks, welcome back to Honey Money SG, and this is another episode of Talking to Myself about building your personal finance journey. Today's video, let's talk about building retirement funds as well as some of the tax strategies that you could use to actually reduce your income tax. Because you know, right, after you have started your first job, maybe the next thing is to look for the next low-hanging fruit. And maybe some of you may think that retirement is such a far away concept for you because you are in your 20s and maybe you think that it's only for old people to think about retirement. But you know, the truth is the earlier that you plan for it, the earlier that you can prepare for it, and there are more options that you can take. So let's start with some of the options for retirement funds that you can start to look at. And the first one being your CPF or CPF Life. Now you should know that you have to contribute a mandatory 20% of your monthly income to your CPF, and part of it goes to your ordinary account, your special account, and your MediSave account. And then when you turn 55, actually some of it will be transferred to your retirement account, but the balance will still be able to withdraw if you have hit the full retirement sum, which is 192,000 in year 2022. So what happens if you actually manage to build a CPF so large enough that it's way above the full retirement sum? Now you actually have a bank account in the CPF that you can actually withdraw like an ATM, because now you can actually withdraw your CPF through PayNow. You know that, right? And it's like immediate transfer. I think it's like a few minutes and it will be going to your bank account once you have started the CPF withdraw function. And if you have watched my CPF shielding video, then you should know how all this works, because it's about protecting your high interest special account funds such that these funds that are shielded will not be taken by the retirement account funds. But that is quite a complicated concept, so I'll refer you to watch that video instead if you want to fully understand the CPF shielding. The other option of CPF is actually CPF Life, which can start kicking in at your age of 65. Because at the age of 65, you can start to choose which plan of CPF Life to go for, whether you want to go for the basic plan, the standard plan, or the escalating plan. Now, I will not talk too much about all these CPF Life plans because those are really quite far ahead for me. But if you don't know what to choose, let's go with the standard first, right? And the more funds that you have in your retirement account, the more funds that you can withdraw out monthly as your CPF Life annuity plan. And so far as of the recording date, no other private insurers can actually beat the CPF Life annuity plan in terms of the value that they give and in terms of the cost. So if you run something really guaranteed and low risk, then why not just continue building up your CPF retirement, go and top up your CPF at a young age, and you can be eligible for some tax relief as well, which is what I always propagate and support on this channel, even though the CPF does not sponsor me in any form or way. Of course, having said that, if you felt that having just a CPF Life is not enough for you, then maybe when you're near retirement age at 60, you can start to look at private annuity plan. Now, how a private annuity plan works is that you pay like a lump sum to this insurance firm, and then they will guarantee you like a monthly or annual payout when you decided to start taking out the money. Next up is interest income, because I'm very sure if you have done some fixed deposits or you actually invested in some bonds or retail bonds or government bonds, then most likely you are familiar with the concept of interest, because you are essentially lending out your money to a government or financial institution, or even some corporate firms, right? When they go and borrow money from you, they have to pay out interest. And because this is considered a much lower risk investment than equities, then the payout or the yield is actually much lower. But at least it's stable, right? It is not subjected to the daily market fluctuations. You don't have a stock market fluctuation like, or even crypto market fluctuation, right? So this kind of interest payment is quite stable, and then you can actually plan out your cash flows really nicely. The next kind of retirement fund is actually coming from dividends, and this can come from your dividend stocks, especially if you invest in the Singapore stocks, because majority of your Singapore stocks like banks and REITs, right, actually do pay out a dividend around 3 to 4% per annum, so it can be quite a good stable yield. But because it is an equity investment, it is subjected to the daily market fluctuations, so you may experience some kind of capital gain or capital loss depending on what price you buy it at. Of course, to start building a stock portfolio, you will need some brokers, right? And you can actually sign up with Moomoo, Tigers, Poems, or even U-Trade to start your stock investing journey, because they do have really good sign-up gifts as well, which are considered free money if you fulfill the terms and conditions, which are quite easy to hit. So how dividends works is that if you invest in a company and the company has positive earnings, then they have extra cash, right? And then they will actually pay out this cash to the shareholders to either reward them and to keep them incentivized to holding their investments in their company. But you know, dividends can either be raised or cut, right? In bad times, they may cut even the dividends and then the stock price will fall. So it's like a double whammy. So you have to be sure of what kind of dividend stocks that you want to purchase. Fundamentally, you want to invest in really good companies. The next kind of retirement fund is actually your supplementary retirement scheme, or we call it the SRS. Now, SRS is essentially like an investment scheme as well, because it is eligible for tax relief at the same time, and you can even use your SRS to buy like local Singapore stocks or even like unit trusts via MoneyOwl or Endowus, which you can sign up for these robo-advisors using my link down below as well. But for my SRS, I actually invest in S&P 500 using POEM's Cash Plus, because there is a stock ticker called S27 which tracks the S&P 500 index, and POEM's Cash Plus is actually the lowest cost brokerage to actually go and use your SRS to buy in the S&P 500. And because you're contributing quite early at your young age, right, then this kind of growth will actually compound, especially for an index fund if you believe in the world economy. So once you have reached the retirement age of 62 or 63, you can actually start withdrawing from this SRS and start to decumulate, right? Because you can't be investing and accumulating all your life without spending the money and then leaving it as inheritance. So really, once you have reached the retirement age, just live a little, take out some money, go on some trips, and spend it lavishly. I mean, you have earned it. Just make sure you have sufficient retirement fund for your remaining lives. Okay, the next two retirement funds is regarding property, because I know Singaporeans are very excited about property, right? I mean, our property market is really sky high, and a lot of people are actually looking to buy property to secure rental income. And rental income can actually come in two forms. One, you rent out your entire apartment or your entire house. That means you're fully tenanted to this tenant. Or you can just rent out a spare bedroom, right? Because when you are older and your kids have moved out, then maybe you have a spare bedroom for rental and you maybe don't need such a big space in your room anymore. Now, the other way for property is actually to downsize your property, because like I said, your children have all grown up and moved out. Then maybe you don't need such a big house to actually go and handle, right? Because you can actually move to a smaller size flat. HDB has actually promoted seniors to actually go for a smaller size flat. Not only is easier to clean, but also once you have sold your existing flat for a higher income, then you can use it to actually fund your retirement, which is quite good, right? Now you have a new flat, you don't have to manage so much of your household chores for a smaller space, and then you can have additional retirement funds once you have unlocked that capital gain from your previous property. So that were some examples of retirement funds that you can choose to adopt. But let's talk about tax strategies now, right? Because everyone needs to pay tax in any way. Now, I talked about tax strategies in one of my previous videos last year, explaining about my tax relief strategies. And one of it is actually topping up CPF. And I'm sure if you have watched my channel long enough, I always advocated for people to top up their CPF and build their retirement funds. Not only is to really build retirement funds, but more for the tax relief, because you can top up to $8,000 per year in your special account or your MediSave account. Of course, I always ask you all to go for the MediSave account first, because MediSave account, you can use it to pay your private insurance like your integrated shield plan. Other ways of tax relief strategies like topping up your SRS, attending ICT as an NS man, or even doing donations for the 2.5x tax relief, I think those are secondary. I think the first thing you should do is to go and contribute to your CPF first if you want to look at the tax relief strategy. Of course, it comes with the understanding that your CPF is actually a one-way traffic. Once you put it in, you have to wait for a really long time for you to be able to withdraw out. So there are definitely pros and cons of this. Every time I talk about CPF, there will definitely be a lot of colorful comments in the comment section, right? Telling me how I'm wrong, how I'm really short-sighted, how I'm really missing the picture. But you know, every man on his own, right? One man's meat is another man's poison. You can say what you want, but really just do what you really want to do. I don't think I'm forcing it down on anybody's throat. Like I mentioned, for my retirement funds, you can actually choose from a few. You don't have to stick to one. You don't have to just use CPF and then say CPF is a bad strategy. You have so many sources of retirement funds like investing, dividends, and even bond interest, right? Or even rental income. So you can really go and build your multiple source of income before you actually retire, and maybe adopt some tax strategies along the way. I think that is more important than really criticizing other people's strategies. So that would be the stage 3 concluded for your personal finance journey. I think after that, then we can start to look at other things like housing, like investing, because you want to start with the low-hanging fruits, right? In my previous video, I talked about before your graduation, what should you look at? And then at the stage 1, in your first job, what should you do? And in my stage 2, I talk about how to actually build side hustles. So this will be the stage 3 of the video. But if you want to look at my stage 2, right, I talk about how to actually build your side hustle empire and maybe some of the options of side hustle that you can choose to take on. So you can refer to that stage 2 video over here. With that, thank you for watching. My name is Christopher. This is Honey Money SG, steering young adults to financial independence.